Welcome back to another episode of the Frugal Millionaires podcast, where we focus on all things personal finance, self-development, and business. So let's go ahead and get right into it.
My name is Brieon Mitchell, a corporate professional, investor, content creator, expat living abroad, and a frugal millionaire.
We're picking back up here with part 2 of the series. And basically throughout this series, we're going to be talking about specific steps along my journey of starting from zero and ultimately getting to frugal millionaire status. And so I want to be as detailed as possible. I want to give you all as much information as I can so that this can help you create your version of success. And so just for those of you who are just tuning in with us, please go back and take a look at part 1. I'm sure there's a lot of information that will help you to understand and to grab the concept of where we are about to start here with part 2. So quick recap. We talked about in part 1 some of the key steps, starting with having a whatever it takes mindset and going from step 1 to step 2, which is being able to earn income. And we talked about reasons for having a job, which is, we're assuming you're starting from nothing. So you're going to go and get a job. That job is going to allow you to generate income. It's going to allow you to take care of your life's basic needs. And also it's going to allow you to develop those skills and learn new things that you perhaps didn't know before. So you're going into working this job with a plan. And then you're going to reduce your living expenses and your lifestyle, aka living below your means. After that, the next step is you're going to start developing and learning a high income earning skill. And once you do that, then you're going to start your business. So let's go ahead and pick up for this episode. Where we're starting out now is we want to go a step deeper. We talked about starting a business. We gave some examples of what types of businesses, and we talked a little bit about some of the tax advantages of those businesses. So I want to share with you all why I feel that being a real estate professional should be a part of your portfolio. And again, we're talking about side hustles. We're talking about earning additional income. We're talking about earning income outside of your normal 9 to 5. We want to keep that full-time day job or night job, whatever it is. We want to keep that primary source of income, but we also want to add to it. We want to supplement. Again, I told you, one of the keys is you need to work and generate income more than you do anything else. This is more than you sleep, more than you hang out, more than you socialize and do everything else. You need to be generating income more than you're doing anything else. So let's look at some of the key aspects of why I believe being a real estate professional is going to get you to the next level and how it took me to the next level. So we start out by looking at earned income. I had a day job at that time, and quite naturally on my day job, I was making earned income or earning wages during the day job. And so this is taxable income, right? And at the same time, starting a business as a real estate investor allowed me to invest in rental properties. And this was long-term rentals where you place a tenant there. You have a minimum of a 1-year contract with that tenant. And so what I learned before I ever started the business is that you have to do your homework. You have to do your due diligence. Why? Because you need to know exactly where you're going. You can't go anywhere without a roadmap. You can't go anywhere without a GPS. So you need to know exactly where you're going. So after researching and studying a number of millionaires and even billionaires, I understood that some portion of their portfolio was allocated toward real estate. And it was primarily, real estate offered the advantages of cash flow for income producing real estate. It also offered the advantage of appreciation, and also another advanced method of forced appreciation that you're able to apply. But it offered a huge number of tax advantages that simply having a business didn't offer. And so it gave real estate a leg up. And so when your income starts to rise, that also means your tax bracket starts to rise as well. So higher income, higher percentage of that income goes directly toward taxes. And so let's look at the step-by-step process that I took. So we first started out, my team and I, by purchasing foreclosed properties. And when we look at foreclosed properties, I want to be able to go through and give you all very specific information. And the first foreclosed property that we acquired, that we invested in, it was a learning experience. I have to be totally honest. It was a learning experience. And I think with having a learning experience, you learn what to do and you learn what not to do. So if we go back to February of 2010, at closing, you have what's called a settlement statement. Anytime you're either buying or selling, you have a closing statement. And so let's just, for the sake of this video, let's just say real estate investment number one. February 2010, we acquired the property, and at closing, I actually had to pay $3,866.10. That's the portion that I had to bring to the table to be able to close and acquire this rental property. Now, looking back at that, quite naturally, it was my first time. I didn't really understand a settlement statement. So I will tell you here, key points. If you're seriously interested in investing into real estate, make sure you understand numbers. The settlement statement is full of numbers, full of line items. Make sure you understand each figure, how that figure was accumulated, and also what each line item represents. Why? Because I can tell you from the first all the way up until settlement statements I've seen that I've had actual transactions on, even up till 2022. Every single one of them, I've found a mistake. And that mistake can be small or large. But the bottom line is it results in money. So you need to make sure you're not losing money by not knowing or not being aware. All right. So purchases a property in 2010, and there were some renovations that needed to be done to this property, and those were done. And then we ended up renting this property out to a long-term tenant. And so you fast forward 3 years later, February of 2013, we sold the property. So throughout this time, we were able to take advantage of the rental income that was coming in. We were also able to take advantage of the repairs and improvements that were done to the property. So I want you all to understand repairs and improvements that are done to your rental property that you're putting under your business name, because the business owns the rental property, not me or not you. The business owns the rental property. That's step one. So you're able to deduct those repairs, improvements, and also maintenance. Hot water heater goes out. Have an electrical issue at the property. AC, air conditioner compressor, goes out. All of these things, you have to be able to account for those in a very systematic way and have a very good accounting system. And how do you do that? You have a business banking account. Actually, you have several business bank accounts. You have one business bank account allocated for the income. You have one business banking account allocated for the expenditures or the expenses. And then you also have a business banking account that's allocated for taxes. And sometimes you may have taxes that are escrowed, and these are property taxes. And so this could be local property taxes, or in the case, it could be county or parish if you're living in the state of Louisiana. So making sure you have an account for taxes, but also you want to make sure not just property taxes, the business income. So you want to make sure, as I said earlier, you consult with your attorney to make sure you set up the proper strategy or structure and you form your entity properly so that the business itself will have a taxing account. And that can be under C Corp or the S Corp or under LLC partnership. However you do it, you need to account for taxes that the business may be liable for. Also, you want to have another account for savings. So whatever income after the expenses, after you've allocated for taxes, after you budgeted for your miscellaneous, the business should be saving money. So put those accounts in place. Getting back to the specifics of the deductions, once you're able to write off those expenses for maintenance, for repairs, for the roof, for the hot water heater, AC, electrical, whatever, you're also able to depreciate the cost of that house over 27 and a half years. So you want to make sure that you're able to get depreciation, and that's also being deducted in your taxes. Huge, huge, huge benefit. And we're going to get to an actual example so I can show you how the math works, and it may click for you a little bit better once you see the numbers. In addition to the depreciation, what you also want to focus on is, are you writing off the mortgage interest? Did you pay cash for this, or do you have a mortgage? So in my situation, I actually had a mortgage on this first rental property. So we were able to also write off the mortgage interest of this asset. And so going on a step further, there's a number of advantages, including the insurance, including the taxes, or property taxes, that you're able to, write off and deduct, including having the quarterly pest control, including other services that you're having done for the property as well, like lawn cutting service. All of these are expenses that you should be able to deduct. Why that's so important is because in most cases, your expenses and the tax deductions, the tax benefits, are going to put you at what we call a paper loss. That paper loss is able to be deducted against your earned income, which lowers your tax liability. That's where the significance of real estate comes in at. And so, as I was mentioning, we get to 2013 and we sell the house and we walk away from the closing with a profit of $15,645.61. So if we look at, we had to cut a check and make a payment to acquire the house. And we were given a check at closing when we sold the house. That was a difference, which is a net profit of $11,779.51. And that's on the very first property within 3 years. Now, that was the one transaction. But imagine over 3 years, we were also able to take advantage of those tax benefits. So real estate in itself, it's going to allow you to take more of your hard-earned W-2 income home. And I know this is very specific to those of you who all are in the United States. Now, when we also look at the power of real estate, the second thing I want you to really pay close attention to is the method of real estate that you're investing in. So rental asset number one was under rental real estate, long-term rental. So then we took the profits from this asset, and then we started to invest next into what we call tax deeds or tax liens. And being able to invest in those tax deeds and tax liens, we were able to acquire 12 properties in 2010. So in a very short amount of time, we were able to harness those lessons from the acquisition of that property in February 2010. And we were able to leverage that information. Information is very, very important. But what's also equally important, and I want people to realize this, the difference between you and the next person can be something as simple as the speed at which you learn, the speed at which you comprehend information. So imagine you and another individual, you're both learning the same lesson, but the speed at which you comprehend and implement can be the difference of who moves further, faster. So I'm sharing that because that's very, very important to understand that the information that you're receiving, you don't need to sit on it. You need to apply it, implement it, take actions immediately. Go ahead and get to work as soon as you get information. So we took the information from this acquisition in February of 2010, and just 4 months later, in June of 2010, we started to invest in another form of real estate, which is known as tax sales, or tax liens, or purchasing tax deeds. And so in June of 2010, we purchased 12 properties. And at the end of the auction, those 12 properties were at a total cost of $17,841.17. Now, that was in 2010. What I want to share with you is that during that process, those tax certificates had a 36-month redemption period. And some of you all who are familiar with tax liens and tax deed sales can attest to that. Depending on the jurisdiction, there's a redemption period. And sometimes there's not a redemption period. You buy it and it's yours. But these liens had a redemption period of 36 months, meaning that the original owner, had 36 months to come back and pay a fixed amount, which would satisfy the cost that I purchased it for, plus an additional interest and penalty that was due to the local parish taxing authority. In addition to that, there was an investment amount attached to my purchase. And at that time, I believe it was somewhere around 1% per month. So anytime we purchased those, we purchased it with the idea that some owner may have forgotten to pay their taxes or may have paid them late. And so we were able to come in and purchase them. Now, what I can tell you is that the majority of those, so I would say 8 out of the 12 were redeemed within a 36-month period. And so the total cost that those 8 properties, what they generated in return back to us was $16,188.87. And so that's a difference of $1,652.30. And I know we're being very detailed with numbers, but I really want you all to get it. I really want you all to get where we're going with this. So when we take a look at the difference, that difference of $1,652.30 is ultimately what was the business's out-of-pocket cost on the 4 properties that were not redeemed. And I can tell you, I still own those properties today. And just imagine over a period of time, that those properties will increase in value. And so imagine paying approximately $1,600 and the value of those properties exceeding $300,000. That's a major win. And so we were very intentional about the strategy that was being implemented. But I want to share this because it's not a boast, it's not a flex, but I want you all to understand what's possible, what's attainable. I didn't do anything unique. I didn't do anything that anyone else hasn't already done. The only thing that I did was I took action with the information that I had. I applied the information that I had. And we were able to get a better result on investment number 2 versus investment number 1. And investment number 1, we were satisfied with the result. I mean, being able to step into an investment and make $11,700 US is a win. I don't care how you look at it. It's a win. And that doesn't include the numerous thousands and thousands of dollars or tens of thousands of dollars in tax advantages and benefits. So investment number 1 was a win, but we see the game gets larger at investment number 2. And that's what I want to share with you all. You have to get started. Stop sitting on the sideline. Stop waiting for somebody to put you in the game, and go ahead and get started. And if you don't know how to get started, go back and take a look at episode number 11. The video here is posted in the link above, and you'll understand how you get started and get in the game and start your business. But once you get started, give real estate a consideration in terms of having some percentage or some portion of your portfolio. Now, quite naturally, you want to do other things as well. I'm not saying focus specifically on real estate, but whatever it is you focus on, whether it's real estate or anything else, focus on what can I do with the little that will have a high return. Because I can tell you, if anybody asks me, I'm going to tell them, go and invest in tax deeds, go and invest in tax liens. Learn the game so you know how to play the game. Because $1,652.30 for the game, I mean, that's a no-brainer. That is clearly a no-brainer. So learn the game. Learn how to play the game. Now, let's go ahead and go through this example. I just wanted to talk about those 2 real estate strategies of rental property, tax deeds, and liens. There are a number of other real estate strategies out there. I'm actually involved in a couple of partnerships as well, whereas we invest in commercial income producing properties as well. So there's a number of other strategies out there, but research the strategy, see what works for you with where you are. Start where you are with what you have. And I can assure you what you have is enough. And just for example purposes, there are tax lien certificates out there that you can purchase with as little as $100, $150, $200. So get in the game with what you have and start right where you are. So let's do an example. I want to talk about numbers. You have to be good at understanding numbers. I truly understand that you may have a passion, and having a passion for what you do is great. But when you're in business, your bottom line is not going to say passion. Your bottom line is either going to say you're positive or you're negative. So we really need to become students of business. We need to become students of understanding the numbers. Let's not get caught up on the hype of business more than we're caught up on understanding the ins and outs of what makes a business successful. And that comes down to the numbers. If you're not familiar with what's a profit and loss statement, I definitely encourage you to get familiar with the profit and loss statement. I encourage you to get familiar with a balance sheet. I encourage you to get familiar with a business tax return. These are things that have a lot of numbers, and these numbers can look very intimidating. They can actually scare you in a sense. They can actually make you want to give up on pursuing that business. But I'm here to tell you, those numbers are not as intimidating as you may allow them to be in your mind. So what I want to encourage you all to do is really start to focus and hone in as a businesswoman, as a businessman. Focus and hone in on your business acumen. Sharpen your business skill to become good at dealing with numbers, understanding numbers. I don't care how good you are at your craft. If you don't understand the numbers, it's only a matter of time. It's only a matter of time before things go bad. And we have so many examples around us. How many times have you seen someone very successful in their craft, whether this is an athlete, whether this is an entertainer, or whomever, very successful, very gifted, very talented in their craft, but they went broke because they don't understand the numbers. And the numbers is what's gonna make or break your business. And we have to be concerned more about the business of me. You need to be concerned more about the business of you than you're concerned about everything else. What's going on TV? What's going on social media? What's going on in the workplace? You gotta be more focused, more locked in, more concerned on the business of you. So let's start with this example I've been promising you all, because I want to really give you all some numbers. And so I'm opening up my calculator here so that we can go through some numbers. And we're going to put this, my team is going to put these numbers up on the screen. So let's go back to the annual income of $30,000 that we looked at in part one. And for example purposes, that's the annual income. And let's look at some realistic figures of what the taxes may be on that. So there was some new information just released within the last week by the Internal Revenue Service, the IRS. And so if you are a single filer, this is for taxable income over 11,000 US dollars, but under $44,725. So 30,000 is going to fit within that category. The tax due is 1,100 US dollars plus 12% of the excess amount over 11,000. So that will be 12% on 19,000. So let's go through the numbers. We have some time here. Let's go through it. How much tax will you actually be assessed on an income of $30,000 as a single filer? And then we'll do the example as a married filer. So we take our 30,000 and we're going to look at the initial assessment of 1,100, which we put it in here. And then we look at anything additional or excess, which would be 19,000. And you have to pay 12%. So let's see what that figure is. 19,000 times 12%. that comes out to $2,280 US. So we take that figure and we add back into it the 1,100, which brings us to a total of $3,380 US, right? Now, let's divide that by the annual income so that we can see what's our tax percentage. So we divide $3,380 by 30,000, which is representing the annual income. That brings us to 11.27%. So you'd be paying 11.27% as a single filer on $30,000. All right. We're going to come back to that, by the way. So let's jump down just a little bit to look at what would be the income bracket for married filing jointly. And of course, there's a lot of other statuses. We're not going to go through each one of those. I just want to do these two for example purposes. These two are the most common, but we are aware there are other filing statuses out there. So the next category is married filing jointly, and we look at over 22,000, but under 89,450. And so taking the same figure of 30,000 US dollars, the tax due would be 2,200 plus 12% of the additional amount over 22,000. So the game changed a little bit. Let's see what's the difference. So we're going to put in here 8,000, which is the amount over 22,000 where you have to apply the 12%. So 8,000 times 12%, that brings you to 960 US dollars, right? Now let's go and add back the 2,200 that is the initial assessment. This brings you to 3,160 US dollars. All right. So let's divide that amount back into the 30,000 to see what's our effective tax rate, which would be the technical terminology. What's the effective tax rate, which is the percentage that you would pay on your earned income based on the tax amount that's due. So we're going to divide 3,160 into 30,000, and that comes up to 10.53%. So let's look at, as a single filer, your effective tax rate on the same amount will be 11.27%. And in married filing jointly, you get somewhat of a lower or reduced amount at 10.53%. All right. But ultimately, this is still your hard-earned income that is being taxed. So what we want to look at is, how can we focus on effective, legal, ethical strategies by now having our business as a real estate professional allow us to be able to further lower our tax liability. So for example purposes, we're going to go with the higher percentage, which is basically filing as a single filer, and the effective tax rate of 11.27%, just for this example. So let's look at, we went out and we purchased a piece of real estate, and we happened to purchase that real estate, which it's not the best piece of real estate, but also it's not the worst piece of real estate. Somewhere in your middle range, you purchased a home for, let's say, $60,000 US. And you went out and you mortgaged that home. And based on your mortgage for that home, quite naturally, a certain portion is allocated toward interest, a certain portion is allocated toward principal, and a certain portion is allocated toward your taxes and your insurance if they are escrowed into it. So we're going to assume they're escrowed into it. So this is where the power of real estate really helps you. The power of real estate really helps you by focusing on, okay, what is the mortgage interest amount? So this is what we're going to do. And I want you all to track these numbers. I'm going to track them as well here on the tablet. So we're going to start out by saying that throughout the year, there was an amount of $7,500 in mortgage interest. All right. For example purposes, and my team is going to have all of this up. You should see it on the screen there. So that's for mortgage interest. Now, also, you have property taxes. And let's assume you have local and you also have county property taxes. And combined on those taxes, let's just say for the purposes of this equation, the total of those taxes was $2,800 US. So we got $2,800 for taxes. All right. Stay with me. Also, you want to take a look at not just your mortgage interest, not just your taxes, but if we go back to the example I gave of real estate investment number one that we did as a long-term rental, we can assume this is a long-term rental. We can assume it's a short-term rental. But purchasing a house for $60,000 US, you're likely still going to have to do some repairs, some improvements. You're likely going to go and have to patch the roof. I don't think you'll have to do a full replacement. That likely probably should have been negotiated in the transaction. So I wouldn't expect you to have to do a full roof replacement or anything like that. You may have to do some plumbing, some HVAC, or some electrical work. And let's just assume, for numbers purposes, you've had to put about 20% of the cost of the house back into repairs and improvements. So 20% of $60,000 US would be $12,000. So let's say 1,200. All right, and this is in repairs. So let's look at everything is going well. You've done the maintenance, you've done the repairs, you've got your property taxes, you got your mortgage interest. Now let's look at depreciation. And for the sake of this video, we're not gonna go too far. We're not gonna go too deep. I know some of y'all are more advanced and, we're gonna go with the simplified depreciation method. And so what we're gonna look at is how can we depreciate this asset over 27 and a half years. All right, I'm getting my calculator opened up. So we have 60,000, very simple, divided by 27.5. All right, and so that gives us $2,181.81.8. So 82. So let's take 2,181.82. And that's our depreciation. And again, there's advanced methods. I mean, you can go and do a cost segregation study and you can accelerate depreciation. There's different methods of depreciation, but we're not gonna get too technical. We're not gonna go too deep. We're gonna keep this example very, very simple and straightforward, because what's important here is we're trying to show you the power of real estate and its impact on helping you to bring in more of your earned income. So that's a later video for a later time to go into those advanced methods. By all means, it's out there. Please go and look up on it, study it, and you'll definitely learn something about depreciation, a lot of information. So depreciation, we have that captured. Now, we also want to think about, as I said, you want to think about the lawn. You want to think about having a quarterly pest control. And you also want to think about your insurance. So let's tackle this one by one. So we look at the lawn. Let's assume it's not a very big lawn. We're just assuming it's going to be $100 per month. And during the winter time, they're gonna, come and do the leaves removal. They're gonna come and pick up sticks, come and pick up trash and maintain during the 3 months of the winter season. So $100 would be roughly $1,200, and it may be higher than that depending on where you live. Definitely understand that. So that's gonna be for lawn. Now, let's take a look when we're talking about insurance. There's different types of insurance. You want to be able to, as the homeowner, have coverage that's going to be sufficient for you as a homeowner, but you want to require the individuals that are renting or leasing, whether it's short-term or long-term, to be able to also purchase insurance for their use. But to protect you as a homeowner, let's assume that policy is around $150. I mean, insurance has went up tremendously over the last 3 years, I would say. So let's look at insurance and say $150 US dollars per month, and that will get us to $1,800 for insurance. So we're capturing what I would categorize these expenses as operational expenses. These are all related to the operation of this rental asset. And so having the mortgage interest, taxes, repairs, depreciation, the lawn, as well as the insurance, all of these are tax deductions. But again, make sure you're doing this under the business name. The business owns this asset, not you. Protect yourself. Somebody is waiting around the corner, and I'm not a doom and gloom type of guy. I'm very positive, very optimistic, but I'm telling you, somebody's out there and they're waiting for you to make a misstep and for you to have a liability on that property. And then you're on the hook. Everything that you've worked hard for, and this could be your pension, your retirement, whatever personal assets will be pulled into a lawsuit if you're sued. So I want to make sure you're very astute and you're focused on building a rock solid legal strategy to complement your investment strategy. It has to be twofold. Don't have a very rock solid investment strategy without a legal foundation. It's going to crumble the first time you get litigation. And we'll do a video about that. We're very familiar with litigation. It happens. It's a part of being in the game of business. You're gonna get hit. You're gonna get roughed up. This is business. It's not a pretty game, and it's not for everyone. So later date, later time, that's coming soon as well. So let us continue to move on and go through these expenses. Let's look at what additional operational expenses that we may have left out. So we see that we've basically done every single deduction so far. So I just want to double check this against a spreadsheet that we have here, the team, just to make sure we didn't miss anything. So when we look at this, we're basically seeing that all of our expenses, I need to make this just a little bit bigger. All of our expenses related to the depreciation, the interest, it's all here. The insurance is here. Also the taxes is here. The pest control, the lawn, and the repairs. We have it all here. So those are the operational expenses. Now, I want to segregate the operational expenses of your business from the administrative expenses. Two totally different things. Operations and administrative, two totally different things. And so I mentioned this in part one of this video, but I want to go back and address it very specifically here. So when we start to look at administrative expenses, I want you to think about, again, your home office. You've got to have a portion of your home allocated to where you do business. And this is where you have your computer, your technology gadgets, whatever you're using, tablets set up, your printers, your Wi-Fi, your home networking system, whatever it is. But there are sometimes things that may just simply go unnoticed or forgotten. So for example, you're gonna need software, and these software or programs could be Microsoft programs. This can be antivirus programs to protect your system. Again, those are deductions that you need to be able to write off. So let's make a line item here that says home office. All right. And so we're going to start with having a Microsoft Office subscription and also having antivirus protection. And by doing that, we're going to allocate just a cost of $100 per month. Of course, quite naturally, these expenses should be your actual expenses and not estimated. They should be the actual. You should have proof of all of those expenses. So we're just going to allocate, for the sake of this example, $1,200. So after we've already allocated for the software, then we want to look at a portion of the utilities. So quite naturally, you're going to have internet in your home. Most people have it. You're going to have your electricity. Some may still have gas or other utilities. You're going to have your water, so on and so forth. You want to be able to allocate a portion of those utility expenses that's equivalent to the size of the portion of your home office. So for example, if your home is if it's 1,000 square feet, then let's say 10% of that is allocated toward the home office, which would be 100 square feet. So you want to take that 10% and apply it to the utilities, the internet, and also the insurance of that home, which is covered by a policy, just for your home office as an expense against your business. And as I said earlier, you're going to do a number of things. You're going to do marketing, you're going to do advertising, and this can be on social media, this can be a website, this can be whatever. So let's go ahead and put a number toward this to say, for those utilities and 10%, over the year, that came out to be $800 US, utilities, including the insurance. All right, now let's say for marketing and advertising, you're advertising your home to potential clients and renters on websites, social media. Let's say you spent $500 US in marketing and advertising. 500. All right. So you're also utilizing your business vehicle, and you have the expenses related to your business vehicle. Let's say that those expenses related to your business vehicle came out to be roughly $800 US per month. That's your maintenance, your fuel, your lease, or your payment, financing payment, plus your insurance, $800 US. Let's also look at your travel. So maybe throughout the year, as a real estate, you wanted to stay up with the industry. You attended one webinar, you attended one conference in person, and for the conference in person, you traveled. You actually took a flight, you went there for a 5-day conference, you stayed in hotels, you had meals, so on and so forth. Let's just assume your travel expenses came out to be $2,600 US for travel. All right. And let's just take a look at two other things, very, very important. The amount that you paid for those continuing education courses. Let's just assume you spent $500 on continuing education. All right. And there's a number of other things that we can continue to go through. But the one I really want to highlight here is very, very important, is making sure your professional fees. I can't stress how important it is for you to align yourself in your business, both personally and from a business standpoint. Align yourself with a very qualified individual or either company. And this individual needs to be a tax professional. And there's a number of tax professionals. I'm not going to get into all the different qualifications and the letters, but align yourself with a tax professional. This can be a CPA, this can be tax attorney, whomever. But get someone who knows exactly your situation, who understands it, and who researches the IRS code to ensure that you're able to maximize on the tax advantages and benefits. So you should have a line item for your tax preparer or your tax professional. And you should also be sitting down doing tax preparation and tax reviews before you sign. Never sign something without understanding it. And it's their duty to educate you, to make sure you understand it. And if they can't, you have the wrong person. You should start looking for somebody else. And I'm saying that because I've used several over the years. And it has to be a situation where it's mutually beneficial. It cannot be a one-sided relationship. And that's also when it comes to legal attorneys. You need to have a very reputable business attorney who can give you sound legal advice. And so make sure, for your professionals, you have a line item. So I'm just going to put $1,500 here for professional services. Depending on your situation and how complex it is, it could be more, it could be less. So let me just look and make sure we're not leaving anything major. I know we're leaving some things off, but we've hit most of them, approximately 90% of them or more. But I just want to make sure we're not leaving off anything major. So we have the bulk of everything. So let's go through now and start to calculate up and how this will actually work. So we're going to also educate you and drop a link on, there's a tax classification for real estate professionals. It's very important that you research that and you understand real estate professional, because that will ensure you're able to benefit significantly from all of these deductions. So let's go ahead and add all of them up right now. So we look at the first one, mortgage interest of $7,500. We look at taxes of $2,800. We look at the repairs of $12,000. We look at the depreciation of $2,181.82. And we look at the lawn of $1,200. We look at the insurance of $1,800. We look at the home office or the administrative expenses, starting with software, of $1,200. We look at utilities in your home office of $800. We look at advertising, $500. We look at your business vehicle expenses of $800 US per month, which would be $9,600 on annual. We look at your travel, business travel of $2,600, continuing education of $500, and then we look at your professional $1,500. So now that we have a total of all of our business expenditures, we're looking at right around $44,181.82 in business expenses, which include both operational and administrative business expenses. So what we want to look at next is what income that we have in. We have to be able to balance the income against these expenses, which would give us our overall business profit or loss for the year. So when we look at the rental income that this property is generating, $14,400 US per month, which is an amount of $1,200 US per month. Again, this is all for example purposes. So $1,200 US a month on an annual basis is $14,400 US. And so when we subtract that amount against the business expenses of $44,181.82, then we come up with the business itself sustained a paper loss. Now, don't misunderstand this. while the property itself still generated income and you made that money, the business entity generated a paper loss or loss on paper. And that loss came up to be a negative $29,781.82. As a real estate professional, once you're able to say, I qualify as a real estate professional as per the IRS tax classification, you're gonna have, one, to meet this classification, you're gonna have more than 750 hours a year, which is basically broken down. If you want to average it out, you're looking at right at around 15 hours a week over 50 weeks, taking into account 2 weeks out of the year, which would count for holidays that you may or may not work. And so those 15 hours spread across your week on real estate activities, whereas you had a material participation. Material participation, you're the owner of this asset, you're the decision maker in this asset. Decision maker in terms of you direct contractors, you direct service providers, you direct other real estate entities that may be working for you or under contract. You are the sole decision maker. So as a real estate investor, you should easily meet the material participation and 750-hour requirement. Now you're able to take this paper loss and apply it towards your earned income. Again, we go back to the example of 30,000 US dollars. So you take a paper loss of 29,781.82 and you apply that towards your earned income, and now you come up with an adjusted gross income of just $218.18. So quite naturally, your tax liability is significantly reduced from being liable for taxes on $30,000 versus being liable for the taxes of $218.18. It's a significant difference. There's no comparison whatsoever. But let's take a look at it. Let's see what would those taxes look like. And let's bring this up real quick. So those taxes would look like you'd pay 10% on any income that's below $11,000. So anything below 11,000 US dollars, you'd pay 10%. So what would we actually be liable for in this case? So we pay $218.18, and our tax liability would be 10%. So technically, you'd be responsible federally for $21 and approximately 82 cents. That's a significant difference and a cost savings compared to $3,381 if you were assessed federally on the $30,000. So let's look at what would that cost savings be. So you take 3,381 and you subtract 218.18 and you have a cost savings of $3,162.82. And again, this is all operating within everyone's moral compass. This is legal, this is ethical, and these are practices that are implemented every single day. And by the way, the IRS allows and permits these tax deductions. So there's no concerns there. But again, I wanted to break this down, and I wanted to share with you why real estate investing is so powerful. And the more money you make, again, lowering your tax liability becomes more of a challenge and becomes more complex. So you want to be able to implement these strategies. And I know real estate is not for everyone, but for those of you who are interested, and those of you who've graduated to that level where you've saved up, you've accumulated some funds where you can put a down payment, you may be able to cover some repairs, or even you're able to negotiate that in your real estate transaction. So this is for you. This is for those who need to lower their tax liability. And for those of you all who are just getting started, please go back and take a look at, it takes you less than $200 if you want to get started with investing in tax liens. And still there are real estate advantages and benefits and tax deductions for investing in tax lien assets as well. So this will help you definitely get your money right and keep your money right. And I want to share this with you. I know it's more detailed, taking a little bit longer than some of the other videos, but it's worth it. And I want to make sure you all actually get it. So please drop a comment and let me know, what did you like? What was maybe not clear for you? And let me know what you'd like to hear going forward. We're cooking up a lot of great content in the kitchen over here at Frugal Millionaires. And so I'm really excited about that. We have something that's coming very soon for you all, where we're going to be doing some live things, where we're doing Q&A and some things like that coming up very soon, so that we can engage more with you all. But I need you to give this video a thumbs up and like if you found it beneficial. For those of you who have not yet subscribed, please, by all means, consider subscribing. We're on our journey now to 100,000 subscribers. And we'd love for you to be a part of the community, and also on the journey of improving and elevating your financial literacy along with us. So until the next one, we'll see you next time. Thanks for tuning in to Frugal Millionaires.